Earnings per share is an essential item on the income statement, and so your income statement isn't complete unless you've calculated that. EPS is the quotient of net income available to common shareholders and number of shares outstanding. In other words, divide net income available by number of shares outstanding. Net income available to common shareholders very often will equal just net income. However, if the company has outstanding certain hybrid securities such as preferred stock, then preferred shareholders generally have a claim on dividends that comes prior to those of common shareholders. And so net income available to common shareholders would be net income reduced by any preferred stock dividends applicable for that particular year. We'll talk more about that later on. Same thing goes for number of shares outstanding. That's very basically just those number of shares that were outstanding, that is in the hands of shareholders during the year. We've already seen the fact that companies will sometimes repurchase shares. Repurchased or treasury shares do not participate in in dividends, and they are not included in the number of shares outstanding. So both numerator and denominator here pretty straightforward on a basic level, but we'll get into those later in a later chapter next in the spring semester, because it does get a little bit hairy and needs to be dealt with separately. Key issues that affect income recognition. There's a concept called earnings quality, and it's really an important issue. It refers to the ability of reported earnings to predict a company's future earnings. I suppose it might not say the ability of earnings to predict it, but the usefulness of reported earnings in allowing you to predict a company's future earnings. When management has the ability to select from among alternative methods of reporting revenues or expenses, the door is open to what's called earnings manipulation, sometimes euphemistically referred to as earnings management. It concerns the planned timing of revenues, expenses, gains and losses to move or shift earnings from one period to another. That is, to intentionally alter the choose methods of recognizing revenues or expenses so as to move income from one period to another to make one period look better than it otherwise would. When companies engage in that type of manipulation, it makes the income statement less useful in making decisions. And the more opportunities, of course, that exist for companies to do that, the more suspect the actual numbers may be. So how does this happen? And by the way, it's sort of the job of the auditors to oversee things and make sure that those things don't happen, or to try to catch them if they do. But it happens in a couple of ways primarily. The first one is income shifting, and that refers to speeding up or delaying recognition of revenues and expenses. Even income shifting occurs in some particular ways, some more common than others. One of those is what's called channel stuffing. Channel stuffing concerns inflating revenues by persuading dealers or your buyers to purchase excess products near the end of the fiscal year. So let's say you want to get those revenues up, so you contact your customers and you say, we'll give you a discount. We'd like to go ahead and ask you to take these. In other words, to try to get them to accept more products, and therefore you get those products off your books and you record the revenues. And now, when they don't sell, though, the customers order fewer units the next time. In other words, if you kind of encourage, through discounts or whatever, encourage your customers to buy more now than they otherwise would, then they don't buy as many next time because they've been sitting on maybe excess goods. So that sort of practice should catch up to the perpetrators but it may not unless somebody is paying close attention to sales returns and allowances. Whenever a company is doing these kind of things, playing these sort of games, they very often think, well, we'll worry about next year when that happens. Or they think, well, we're doing it this one time, but next year is going to be a better year anyway. We won't have to continue playing this game. But of course, that's sometimes overly optimistic. And so what should happen is, in general, is if the company has inflated these revenues and gotten customers to take more products, then when those products don't sell by the customers, again depending on the terms, either the company will receive those goods back, those that don't sell, if there is a return policy, or the seller allows those kind of returns from the buyer, or if the seller doesn't allow returns, they've probably gotten the customer to take those products by offering pretty significant discounts for one, and again that will mean that sales in the next quarter after the period end will be lower than they otherwise would have. So you want to watch out to see if, for instance, that company, you feel like there may be some evidence that the seller, your client, has engaged in this sort of channel stuffing, and you may end up experiencing a lot of excess or abnormally high returns of products after the year end. It's more common in the auto and tobacco industries. Again, another method here is speeding up or delaying recognition of revenues and expenses, taking large one-time charges for asset impairment or restructuring as the need arises to accelerate expense recognition and make future earnings look better. We've talked about the notion of asset impairment, where you might have a piece of land, it could be a building, it even could be an intangible asset, where you say, well, it's lost a lot of value, the market value is not what it was before, or I've kind of jokingly said you've got a piece of land and you've identified that as being a toxic waste site, or there was a Native American burial ground found on it or something like that, and so you write that property value down. That's what's called an impairment loss that we deal with once again later on. Restructuring concerns costs that companies incur in order to reorganize. Maybe it's because they've got new management, maybe it's subsequent to being acquired, or they've acquired some other, they've merged with some other company. Maybe they've got new leadership. And the new leadership comes in and says, we're operating inefficiently. We need to get rid of some people. We need to get some other people. We need to consolidate these departments here. We need to, close down this particular office. Things that may be fairly significant costs, and as a result of that, they could take certainly some restructuring charges, or incur some restructuring expenses. And there is an inclination when this is the case, maybe to overdo or accelerate those kinds of things. And by the way, we may have the opposite, to delay expense recognition by capitalizing certain expenses and amortizing them over future periods. This might be the case, for instance, when you're constructing your own facilities. You're either constructing it yourself or you're playing contractor, and in that, if you're doing that, you're actually accumulating the costs for, say, constructing a building yourself. And there's an inclination maybe to throw in additional costs there, incur expenses that really would be operating expenses, but treat them as if they are costs of construction, like certain capitalized interest costs. And so companies then might take what would rightly be called operating expenses and capitalize them, that is, record them in long-term asset accounts and depreciate them in the future. In general, if an expense item is not going to you can't argue that it's going to contribute to future revenues, then it needs to be expensed. And so anything you do capitalize, you have to be able to defend that claim that it actually is going to provide future benefits. Income smoothing, measures taken to provide more stable earnings from one year to the next in order to reduce the perceived risk of a company's earnings stream. In other words, onward and upward, but not too much. It's kind of, I thought about it over the years. The student who really pushes it one semester and gets all A's may wish they hadn't, because then everybody, parents, and advisor and so on, say, see what you can do when you apply yourself. And so the student may wish they hadn't maybe excelled quite so well, because they've raised the bar for themselves. And so it is with companies. What they would like to do is to show a steady improvement, in the company's earnings and its performance. But improving too much in one period may raise expectations to some level that it's hard to match, in subsequent years. So there's some inclination to try to increase earnings, year over year, but not too much, so that it's not too so hard to measure up to in following years. So how does a company actually do that? Well, maybe a company will increase its allowance for doubtful accounts, which is where we, of course, account for bad debt expense, and increase the estimated uncollectibles related to our accounts receivable. And so it may increase its allowance for doubtful accounts in a given year with a higher charge to bad debt expense. And that way, then in years with low profits, the company may reduce that allowance a bit and charge off fewer or charge lower bad debt expense. In that way, sort of trying to make the lean years look better and the fat years look a little bit, maybe a little bit leaner, in order to smooth earnings. Whenever estimates are involved, opportunities for manipulation exist, and that's why when you're doing audit work, one of the things you look at is to see if the company has changed its policies, if it's changed any accounting policies, if it's gone from FIFO to LIFO, in inventory cost flow policy that it follows, whether it's changing any of its depreciation methods. It used to be a straight line, now it's using accelerated methods or something like that, or whether it's changed its percentages. When we get to accounts receivable, we'll see that there are two basic ways to adjust that allowance at the end of the year, and both of them really rely on some measure of a percentage. So if a company has been, let's say, charging off 3% of sales, account sales, to bad debts, and then this year it drops it down to 2 or raises it up to 4 or 5, then they would need to be able to explain that to make sure there's a business reason for that, and that it's justified, not just some attempt to manipulate, expenses and the allowance account. Reporting unusual and irregular items. The distinction between income and expense items of a recurring nature and a non-recurring nature is important to allowing users to compare results of operations across periods, and as we've seen before, therefore to use the financial statement information to predict future cash flows, future revenues, future profits, and so on. How should unusual or non-recurring items be reflected in income? Actually, this is quite a change from just a few years ago, because there used to be another class of items on the income statement known as extraordinary items, and these were the gains or losses that were associated or that resulted from what were called unusual and infrequent activities. A plant gets destroyed by an earthquake, or maybe there's an embargo on the on products that the company sells, and so the contracts that the company had to sell goods to, let's say Iran or North Korea or something like that, are prohibited by law. Or it could be that there's an extended labor strike, and so these sort of events certainly would could have a serious, significant financial impact So how would we account for gains and losses of that sort? Well, it used to be that there was this consideration of what are called, or designation of what are called, extraordinary items. Now that's changed quite a bit. The accounting profession now has adopted